So you're selling your home. How much of it is taxable? How much of the gain? What are the qualifications? We're going to walk through that. I've got a longer video because as you can see, I've already done all the work here. So if you want to see how I arrived at this, you got two options. One, in the body of this video is a link to the long version of this, and also tied into both this and that one, I've got the worksheet of this where you would also be able to use the numbers where you could put that in to see what your gain is in your specific circumstances. Now, what are we talking about here? When you are selling a home, that is your personal residence, there is a tax law that indicates that if your gain is under a certain amount, it's not taxable. That is phenomenal. What dollar amount are we talking about? How do you calculate it? Well, here's all the end results. You ready for this? Buckle up, take some notes. And if you really want to make sure that you're seeing everything here and how it works, again, click on the link and go get that worksheet. So we've got Sandy and Pat. They're married. They're going to be filing jointly. And they purchased a home in 2015 that cost $750,000. They're selling it for $975,000. They're selling it 10 years later. Now, of course, once you buy a home, there's a lot of other things that happen. Well, when they bought it, they had closing costs. They had some improvements while they were in it. Improvements mean that they didn't have to do anything to the property. They decided to do something to increase the value, to improve it. It's not a repair. Putting in storm windows would be an improvement. Fixing a broken window is a repair. So repairs while that person or this couple live there, those don't come into play here. When you sell it, you got selling costs, closing costs, you got some repairs to sell, meaning the only reason you're doing those repairs is to actually sell it. So if we take that all together, how does it all work? Well, here's a beautiful thing to know. You take one number and subtract everything else from it. And what's that one number? The sales price. So if you take the sales price here, $975,000, then the cost to buy it, the closing costs when bought, the improvements, your selling costs, your closing costs, your repairs, real simple, subtract all of it. So in this example, all of those items, the cost, closing costs, improvements, selling costs, closing costs to sell it, repairs, all of that is $884,000 subtracted from the sales price. It's really simple. What did I buy it for? How much money did I put into it? How much money did I have to spend to sell it? All of that together, that's $884,000. It would be part of what's called your cost basis. Subtract that from the sales price, and then you have your gain. And in this circumstance, $91,000. So you got to figure out, am I got a gain? I got a loss. If you're selling personal residence, well, loss doesn't help you in any way. If you've got a gain, you got to figure out how much. Well, it doesn't stop there. So the next thing to note here is that you've got $250,000 or $500,000 as the exclusion. And you think, oh my gosh, how does this work? Very simple. You, as an adult that owns this, okay, you're a person. And you can only be married, at least from the IRS's perspective, to one other person. And even if you are married more than one, well, on tax return, you can only claim one spouse. My point is, every person gets up to $250,000 of an exclusion on the sale of a personal residence. It doesn't stop there, but that's the start. So if you have married filing jointly, that's two people, Sandy and Pat. Sandy gets 250, Pat gets 250. Combined, it's 500. Very easy to remember it. There is zero advantage to filing separately. Forget thinking about it. It just is no advantage. Here, right now, what we know is then if that gain is less than 500,000, which it is, well, then it's not taxable. However, okay, can't just stop there. There's one other test, so to speak, and it is of the last 5 years, did Pat and Sandy live in it as their primary residence? Don't hear that as they needed to own it for 5 years. They've only needed to own it for 2. The look back is though 5 years. Why is it a look back? Why do you care? What I'm saying though is if you now just do really one simple thing, okay? Here's the date of sale in August of 2025. Now, I don't know when you're watching this. So you just go, hey, in the last 5 years, all the way back to 2020, right? Back 5 years, has Sandy and Pat lived in it for at least 2 years as their primary residence? Yes or no? Yes. Okay. So they've met both qualifications, meaning the gain is less than the exclusion of 500,000. So the amount also coupled with it's been their primary residence for at least 2 of the last 5. Now we have a taxable situation of 0. So if you were to say, well, wait a minute, what if they only lived there a year? Oh, hang on a second, they only were there 3, but they lived the last 2. Or, oh, they had to move and they're in the armed forces and all that stuff. Okay, great. I'm putting a link in the body of this video for all those obscure things. And it's directly to the best source, which is the IRS, irs.gov. So check that out. Check out this. For realtors that I believe and hopefully are tuning in, I specialize in you, but I've got a seminar. Check it out. Please don't tune out. Subscribe. Love you. Appreciate you. All those that are out there, here's the deal. Anything that you can do that then yields a tax-free event is a pretty special thing. So I hope you got what you needed out of this. And with that being said, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. You have a great one.